In an unexpected turn of events, Dick wants to cover your feet. That's right, Dick's Sporting Goods has made a friendly $2.4 billion takeover offer to buy Footlocker, apparently to fight soft demand. Well, that's one reason to spend a few billion. I hear Elon Musk has been doing much the same. Anyway, let's take a look at the numbers here. Shareholders of Footlocker have two options. First, they can accept $24 in cash for each Footlocker share they own, or they can have 0.1168 shares of Dick's for each Footlocker share they tender. Let's see what that translates to for an investor looking to profit from this takeover. If you take a long position in Footlocker at $12.96 per share and wait for the deal to close later this year, at $24 per share in cash, you could expect to generate a return of 85%, which equates to 158% on an annualized basis, which are obviously very impressive numbers. Even the risk-adjusted return is a lofty 121%. And should you apply 50% leverage to the trade, you can expect a 168% return, or 311% on an annualized basis. So far, so good. Now let's see what happens when we plug in the data for the second option, taking shares in Dick's instead of cold hard cash. We still take a long position in Footlocker for $12.96, but we now also short 0.1168 shares of Dick's for each Footlocker share. Additionally, we will likely be on the hook to pay $2.43 in dividends to the owner of each borrowed Dick's share before the deal closes, which will increase our costs basis. This investment could generate a return of 90%, or 167% on an annualized basis, which is even superior to the cash trade. And the risk-adjusted return now sits at 131%. We have seen this before in previous deals, where the all-share transaction yields a superior return, because the acquiring company has to pay less in cash when investors accept the all-share offer. Again, if we apply 50% leverage to the trade, the return increases to 411%, or 762% on an annualized basis. However, we must take a note of caution here. Even though this deal is friendly and is being recommended to shareholders by the directors of both companies, there are still issues that may prevent its completion. In addition to the usual regulatory hurdles, we should be mindful of two core concerns here. First, Dick's is proposing a relatively low price for the shares of Footlocker, which were trading as high as $60 just a few years ago, and may result in protests from the existing shareholders in Footlocker. Secondly, shareholders of Dick's may not be bowled over by the prospect of paying anything for Footlocker. You see, the reason Footlocker's shares have fallen so low over the last few years is due to significant struggles with the business. Footlocker has been hit by the double whammy of Nike attempting to sell direct to consumer, thereby cutting Footlocker out of the supply chain. Second, many consumers have migrated away from shopping malls, where Footlocker stores were once ubiquitous, raising questions about the long-term survival of the company if it isn't able to successfully pivot its offering. So, even though this is a friendly deal, with very attractive-looking numbers, there are potential stumbling blocks which could still scupper this transaction. So, what does everyone think of this deal? Let me know in the comments below, and don't forget to like and follow if you found the video useful. Be aware that all the figures mentioned are the date of my calculations and will change in line with the share price, any changes to the deal terms, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Thank you for joining me today, and until next time, have a great day.